Hello and welcome to Deal Flow, the show that puts the spotlight on merger and acquisition activity on the African continent. I'm Erica van der Merwe. M&A specialists tell us that in the fine print of this year's revision of South Africa's tax law, you'll find some proposals that could have major implications for deal making and the viability of certain deal structures. We're spending some time looking at that in the show with our panel of experts. We get you in the mood for that with our deals of the week. PPC Cement has reached an agreement to buy a controlling equity stake in South African blended cement producer Safika Cement for around $35 million. South African lender Transaction Capital will sell its payment services unit Paycorp to private equity firm Actis for $95 million. Paycorp owns and operates off-site ATMs and installs credit and debit card payment terminals. Walmart is considering making a bid for the Hong Kong supermarket business Park and Shop, being sold by a company controlled by Asia's richest man, Li Ka-shing. The world's largest retailer is weighing up its options ahead of this week's preliminary bid deadline. And Jeff Bezos, the multi-billionaire founder of online retailer Amazon.com, is buying the Washington Post and a handful of other newspaper assets for $250 million. South Africa's tax law amendment bill includes some elements that could have major implications for deal making and the viability of certain deal structures. Well, we've got the tax experts in to look at this. Mark Linnington, Director and Head of Tax at Weber Wenzel, and in our Cape Town studio, Leroux Roelofse, Director for Tax at Deloitte & Touche. Welcome to both of you. Good to have the experts at our fingertips. So Mark, let me begin with you, and Leroux, I'll be asking you this too. In your opinion, what's the spirit of some of these changes to the tax law? Because it really looks as though debt within funding structures is being targeted.
Yes, it has been a focus of National Treasury for some time now. They've been looking at various funding arrangements and tightening the legislation to curb perceived abusive areas. So we've seen legislation in regard to preference shares, which is fairly hard-hitting legislation. And it's aimed at a fairly narrow area of perceived tax abuse. But unfortunately, there's lots of collateral damage.
Well, Leroux, if you could come in here. So quite considered changes to the tax law, as Mark says, perceived abuse of some tax concessions, but the trouble is that the innocent are affected too. What's your opinion?
Yes, unfortunately, that is the case. What we're seeing in South Africa is part of a move that we see globally, where base erosion is the buzzword, and governments trying to protect their tax base. And as Mark says, in South Africa, a perceived area of tax avoidance or tax evasion is around companies that are too highly leveraged and geared in acquisitions and take on too much debt on their balance sheet. And often if the funding is provided from abroad, you find that there's no tax parity and that the lender is not taxed on the interest that is paid whilst the borrower is claiming a tax deduction. And I think, as Mark said, they've been toying with various proposals, and we've been having a discussion really for the last 3-4 years around what is appropriate. This is the latest installment in what Treasury is coming forward with, and unfortunately, there will be a lot of collateral damage.
So, Mark, no surprises. This has been a few years in the making, as Leroux says. So I think every year you're seeing a slightly different variance of it.
Yeah, it started in 2010 in a big way when National Treasury froze Section 45.
And that was overnight.
It was, to everyone's surprise. Yeah. And they were looking back at deals that were concluded in the boom years leading up to 2008 when the subprime issue manifested. And the gearing levels were higher, and they were seeing that companies' taxable income was being wiped out by interest cost. And they reacted very strongly to that by freezing Section 45, but they backed off from that, and their aim was to put in a long-term fix where there was an objective system to determine what is their acceptable level of debt funding.
So a rules-based system.
Yes,
right?
and that's what we're seeing now. We're seeing the rules-based system being introduced. And there are lots of teething problems with the proposed legislation. And it's debatable whether it's a better system than the current discretionary system. My personal view is it is. It's going to give a lot more certainty to companies. They know what they're dealing with. You won't have to go off to SARS and get a ruling for your transactions anymore. And also, it takes a lot of pain away from the whole process, because you don't have to look to a bank's pool of funds anymore to see if they have exempt depositor base anymore. You don't have to concern yourself with the lender's tax status.
Right. So it's a much more predictable outcome, would you say?
It is a lot more predictable.
Luru, so this is Section 45, as I understand it, of the Income Tax Act, this component that we're talking about, limiting the extent to which in a deal structure the interest on debt can be used to offset against the tax liability, if I understand it correctly. In your opinion, are the rules proposed by Treasury fair in this instance?
I would agree that certainly we need to move to a system where we have rules that apply across the spectrum. The current scenario where you have to go for approval to get a deduction is not, it's really not satisfactory. So if we need to know what the rules clearly are. I think where the teething problems come in and the issues come in is that they have essentially the proposal that's put forward around the debt reduction, and this is a limitation, and this is one leg to the proposals. The other leg is around the recharacterization of dividends as taxable income. But on this leg, the proposal that's put forward is to limit the interest that can be claimed to a percentage of EBITDA, roughly 40% of EBITDA, broadly speaking.
So EBITDA being some sort of definition of earnings, right?
It's questionable as to whether or not that is the correct measure, and whether we shouldn't have maybe a balance sheet test where one looks at a debt equity and a company's balance sheet, because taxable income varies from year to year and there could be external factors. And the risk going this route is that you actually could penalize companies at times when they are in distress because their taxable income drop and the ability to offset the interest deduction becomes smaller. So I think one could talk about the test, but in concept, in principle, I don't think too many people would fault that.
Right, so we've looked at some of the technicalities of this, Mark and Leroux. If the legislation were to be enacted as it is proposed now, and I know the comments are in last Monday, the 5th of August, were the second round of submissions on that. If these were to be implemented, Mark, how could it change the deal-making landscape?
I think it's actually going to free up deal-making compared to the discretionary system. I think it's going to open up avenues of debt that are currently not available to for transactions. So you know, we can access foreign lenders now. We can access exempt lenders. We won't have those restrictions placed on us, which are currently inherent in the discretionary system. And there's going to be a lot more certainty as to your tax shield over the investment cycle. So I think it's overall a big improvement.
Leroux, but it does mean less debt being used potentially within deals. Does it make it more expensive then to do deals, and are certain parties then excluded from accessing funding?
Yes, it may make it more expensive. I think one thing that one also needs to be clear on is that there are many different types of transactions that are being done. So certain transactions certainly would be affected and negatively affected. But it is, as Mark says, it's going to free up other avenues that currently are not that readily available. So it will, in particular instances, you will see it becoming more expensive. It's also true, though, that we are already seeing a lot less debt being put into transactions to make them more sustainable. So maybe in the end, not that big a change.
And there's certain kinds of deals. If we look at BE deals, Mark, we know the volume of deals seems to have come down since the peak years of 2007, 2008, 9. But some BE deals still need to be done. Many of them use pref share structures to do that. So there's the proposal that we've just touched on peripherally that could also become more expensive.
Yeah, look, the changes affecting preference shares, they're not damning in themselves. It's still workable. You just have to be very careful. And it's become quite a volatile structure because something can happen in the future that taints the whole structure under these new anti-avoidance rules. So these deals still can be done. Just some of the attributes of these deals could be limiting in some circumstances. But on the whole, it's still workable.
So, Leroux, if we had to just stop and stand back, if you had to describe the animal spirits, the level of confidence in the deal-making environment, what you're seeing as deals come across your desk and you're structuring them, is there confidence, is there optimism? And then with proposed tax changes such as these, are you confident that there'll be sufficient activity in the months and years ahead?
Yes, I'm confident. A lot of the so-called BEE deals need to be done in one sense or other, so they will continue to be done. We haven't seen any proposals that are killing the ability to do deals. One needs to be smarter around it. I think what we'd like to see, though, is particularly in the area of hybrid debt, recharacterizing dividend income into interest income or vice versa. We'd like to see a bit more certainty. We've got a lot of changes over the past 2 to 3 years, and there are a lot of changes being proposed now. And there could be some unintended consequences, for example, excluding or recharacterizing interest as dividends, where listed debt is issued in order to obtain funding. One needs to question the wisdom of that. But I don't see debts dying or deals dying as a result of these changes.
So, Mark, plenty of warnings there. You've also warned about the unintended consequences. But in conclusion, just your sentiment, the outlook for you on the deal-making side.
I think it's overall an improvement. I think taxpayers just need to be a lot more attentive to their tax planning.
Consult their tax lawyers?
Yes, definitely. But overall, it's a good development. I think there are going to be lots of teething problems, particularly with the other amendments around cross-border debt and controlling relationship debt and how it interacts with the new thin cap rules. We actually got a barrage of legislation around this, and it's going to take time for it to settle and to work out how it all interacts and affects taxpayers. So it's just going to make it more onerous on taxpayers to address this, but we're certainly open for business. I don't think there are deal killers here.
Well, Mark and Leroux, thank you very much for your time and for your insights. Mark Linnington is from Weber Wenzel, and in Cape Town we had Leroux Roelofse from Deloitte and Touche. Do stay tuned to CNBC Africa after the break. In Wealth Quest, Samantha Loring and her strategists Quirby and Roland get graphic. Goodbye until next week.